Uh, Thanks for joining us. We're going to give people a couple minutes to join, and we'll get started in 2 minutes. In the meantime, please let us know what you're most excited about for spring, and I'll get started in here.
What are you most excited about, Manny?
Oh, I mean, I'm a warm weather person. I hate the cold weather, so just. I was mentioning before we went live, I was very excited to take my dog for a walk in shorts today versus bundling up. The less bundling up, the nicer the walk. So that just being outside, I feel a little bit like a little bit of a hermit in winter, staying indoors. So what about you? Anything you're excited for with spring?
Yeah, I love all the seasons. So I like skiing in the wintertime, and in the spring we are full on garden mode. So we were out there last weekend getting everything, the raised beds prepped, and mulching, and we can even plant some things up here in the Northeast. So it's exciting.
Do you plant any like vegetables or?
Vegetables, yeah. So we have a pretty extensive garden. We have a little bit of an orchard as well. So
Very nice.
yeah.
Oh wow, an orchard. Okay, that's pretty nice.
Which is an appropriate analogy, which we'll talk about later.
Yeah, a little foreshadowing. We're gonna get started in 1 minute. If you can let us know what you're most excited from for spring and where you're joining from in the comments. Yeah, it's good. We'll be able to go back to your orchard, and so all right, we're going to get started. So thanks for everyone for joining. We know everyone's busy. Today we're really going to focus on how to defer taxes and really maximize what you pass on when you're passing on an IRA to the next generation. Whether you're the individual that's planning to inherit it from your parents, or you're the parent, or you're an advisor or CPA that's working with clients to figure out how to pass this on, we really want to walk you through today kind of the basics of what are the IRA, what are your options to pass it on, and what's a really tax efficient way to pass it on to the next generation so that they can use it efficiently and do good in the world. And just kind of as a quick introduction, so I'm Monty from Valur. I founded Valur, and the whole idea was how do you make it easy for people to identify and understand tax advantage strategies and implement and manage them to really make it of what does a well-run family office do today and make those same strategies accessible to everybody. And so we obviously do a lot of content, work with a lot of advisors and CPAs, and so excited to introduce to George Newfield. He's a partner at Cornerstone. And George, you want to give a quick background on yourself and Cornerstone, and we can get started.
Yeah, I'd be glad to. So Cornerstone Financial Management, we're a registered investment advisor serving clients all throughout the country. And we're headquartered here in New England in the Boston area. Our tagline is wisdom to live and give well. So this is a topic that I'm particularly passionate about. More specifically, I like to help our clients to really give better. Oftentimes that means reducing taxes, and that means more money is left over for the people and the causes that they love and cherish. And so I'm excited about this topic. This is, I've worked with hundreds of charitable remainder trusts throughout my career. So something I'd love to share with our audience today.
Yeah, perfect. And so really kind of jumping into that. So in today's kind of webinar, we'll start with a little bit the basics of what are IRAs, their tax benefits, some of the limitations, and then kind of get into what's changed. So George already mentioned this charitable remainder trust. Charitable remainder trust really became a solution to pass on IRAs because of the Secure Act. So we'll give a little bit of background on what the Secure Act was, how it increased taxes on inherited IRAs, and as a result, how charitable remainder trust became one of those solutions to transfer wealth, and then also dive into kind of what are some broad principles to think about as you want to think about transferring wealth wisely between generations. Some of the things that may be more obvious, or some of those things that may be less obvious, but really critical that you see come up in these situations. And then we'll really dive into the structure that George mentioned of how do CRUTs, charitable remainder trusts, come into play to minimize taxes on these inherited IRAs, really how do you think about managing it, the roles and responsibilities of the different people involved, and then jump into a case study to kind of illustrate what is the value, the financial value to you, to the next generation, and kind of more broadly of using these structures. And the other piece of call is please let us know if you have questions. You can post them in the chat. We'll either address them in real time or when it makes sense, or we obviously have time at the end as well. So let's get started here. I guess, George, maybe you want to give us kind of a quick overview of what is an IRA and kind of the different options there.
Yeah, I'd be glad to. Before we dive into the IRAs, I do want to just comment that folks have been using charitable remainder trusts for a long time. And in some cases, they've been using them with IRAs, but we'll talk about why they're specifically powerful in this context. When you think about an IRA, they are a vehicle that was created to help save for retirement. So, the most popular types of IRAs that folks are familiar with are traditional or rollover IRAs, Roth IRAs, but there's many types of IRAs. Yeah. For the purpose of today's conversation, we'll focus on traditional and rollover IRAs, pre-tax traditional and rollover IRAs. And you can see from the graph here, the whole concept behind saving for retirement in an IRA is you're trying to reduce your taxable income as much as possible during your high tax years. And then as you enter into retirement, as your taxable income is decreasing, you're hopefully withdrawing that money at a lower tax rate. So that's the principle, the concept, and there's many combinations of things you could do to try to reduce taxes even further, like Roth conversions. When you look at the chart there, you can see the difference between purely saving in a taxable account and then saving in a tax deferred account like an IRA or a 401k. So there's certainly benefits to not having your money sort of whittled down over time and allowing it all to compound. Yeah. And I'd like to mention, the 401ks have higher contributions limits than a traditional IRA. So for this conversation, the vast majority of where this will be applicable is most likely in a rollover IRA. Also to mention, 401ks are not eligible for this type of strategy, neither are 403bs. These are really limited to IRAs, which is just something important to keep in mind. When we think about some of the drawbacks or the limitations to traditional IRAs, rollover IRAs, when you do take the money out, that's taxable. Taxed as ordinary income. There are some exceptions, but for the most part, they're taxed as ordinary income. They're subject to required minimum distributions, and there's been some recent tax law changes, push that age forward, but essentially at some point, you have to start taking the money out. And also, if you do need the money sooner and you're under age 59 and a half, you could be subject to an early withdrawal penalty. So that's maybe a good thing and a bad thing. You don't want to have too easy access to these funds, which are really meant for retirement. And lastly, there are contribution limits, which I mentioned. For a traditional IRA, the contribution limits are very low. It's as low as $7,000 per year. For a 401k, 403b, those can be higher. There's a contribution limit for the employer and the employee, and so there's an opportunity to put more money aside using one of those employer-sponsored retirement plans. Yeah.
And I guess just to summarize that, right, is IRAs, they're retirement vehicles. So they're built for you to have money later. So there's a tax advantage now, but then there's limitations on when you can pull it out or when you have to pull it out and how much. But there is a tax. You're not completely avoiding taxes. You're just avoiding taxes today for the idea of, and we talk about this all the time. Everything I think in finance, you're going to somehow come around to the concept of compounding. Paying less taxes now with compounding will create more wealth in the future. But there are those limitations of it is built for your kind of retirement and using that. Now, that being said, and is going to get into this a lot more in the webinar, is people do have, whether they have other money or they don't spend it or they pass away early, it's common that people will have money left over when they pass away in their IRA. So a big topic of this is, and in most cases, those people are trying to pass it on to family. Not all, but most cases is how do you do that efficiently and really maximize what your family gets from that. So
Right.
anything else you think important to kind of call out of the basics of IRAs, George?
Well, I would just say an overarching theme here is really this should be part of a bigger, more comprehensive financial plan. So talk to your advisor, really make sure that you're saving the right way in the right types of vehicles. You're maximizing, any kind of pre-tax savings you can. And so, you want to save taxes both now in retirement and then when you pass it on to the next generation. So there's opportunities throughout your life to be able to do that.
Yeah. And kind of just call out here is if you want to kind of learn more, dive into that, you can set up time with us or George. We'll have our contact information available at the end and in the follow-up email. But if you want to dive into that or kind of understand how to think about this, we'll go through some of that at a high level today, but we can go deeper one-on-one. So kind of going on to the next piece. Now, really part of the reason we're having this conversation is the Secure Act really changed the nature of how do you pass on these IRAs. Back, I say back in the day, before 2019, everything before COVID seems a long time ago. You could pass on your IRA to your children's IRA. So when you passed away, you could roll it over into their IRA and they could keep it in their IRA for their life. And so you could essentially compound those tax benefits of have it grow tax deferred during your lifetime. Then when you pass away, pass it on to your kids' IRA. And, they could wait till they're 59 and a half to withdraw it and have that tax-free growth. The Secure Act changed that. It forced you to take distributions. If you rolled it over to your IRA, you have to take those distributions within 10 years. So instead of if you inherited it when you were 40, instead of being able to wait roughly 20 years to withdraw it, to start withdrawing it, you have to withdraw it all within 10 years. And as George mentioned, you pay ordinary income taxes on this. So you have to withdraw it all within 10 years and pay ordinary income taxes. And, at the high end of ordinary income taxes, you may be paying 52%. So you could be losing more than half of that money. And that's obviously, you lose tax deferred growth and you pay a high tax rate. It really kills and really eats into the wealth that, the previous generation has built. And so this is kind of the big downside of the Secure Act. And this is really kind of where Charitable Remainder Trust came in is, how do you defer taking these distributions and paying those taxes? Now, the one caveat to call out is if a parent passes away, they could pass on to their spouse and the spouse could keep it in their IRA for their life. It's really the most common use case is if it's passing on to anyone but their spouse, where this 10-year rule applies. Anything else you think is important to call out here, George, with Secure Act and kind of how it changed how people think about passing this on?
Yeah, no, this was a huge shift in the way that we've thought about and planned for, passing on wealth, with very few exceptions, surviving spouse could be one. You're going to have to, your heirs are going to have to take this money out over 10 years. And it wasn't accidental. I think we can just call a spade a spade. The reason why this law was changed the way it was to raise tax revenue. They knew that would happen, because if you're spreading it out over the course of your kid's lifetime, that could be 20, 30 plus years. The IRS didn't want to wait that long. They said, let's get our money in 10 years. And so that does present a tremendous opportunity for using charitable remainder trusts to help to mitigate that. I will also say, just in practical matters, oftentimes when somebody is inheriting an IRA from their parents, let's say, for example, they're also in their peak earnings years. So when Manny was referencing high tax rates, think of, they may already be in a high tax bracket, and then you're almost adding insult to injury. So the net result is what happens? Less money goes to your loved ones, more money goes to the government. Yeah. There are options. And so we'd like to, explore one option, one type of strategy. There are many ways to structure this. We're not going to go into all of them, but we'll talk about one specific use case that could really be powerful.
Yeah, and it's a really important piece to hit on, right? Is the difference between your peak earning years, where you compound this, you essentially you could potentially double your earnings, right? And so you can put yourself at the very top bracket. So you're losing
Yep.
half of this versus if you're in your lower earnings years, you can keep significantly more of this. And by spreading it out, obviously, if you would draw the entire principal in 10 years versus you spread it out over 20 or 30 years, you're pulling out more per year. But kind of when we talk about before we get into kind of how you can avoid this kind of big tax on your kind of inherited IRA, maybe let's start with kind of the basics of how to think about transferring wealth wisely, whether it's your person passing it on or inheriting it. What are some of those kind of things to think about? And maybe kind of, George, I want to talk about how you think about it and kind of how you work with your clients or what you've seen has gone wrong.
Yeah, no, this topic here, how to transfer wealth wisely, applies regardless of if you're talking about an IRA or you're talking about a trust account. Really, it doesn't even have to pertain just to financial accounts. It could pertain to, property and, items. So, three key considerations is who is going to be the beneficiary. Consider the potential for some spending guardrails, and we'll talk about some of the benefits of those, and how to think about and minimize taxes on these inheritances. So the first question, in some cases, it's a very obvious answer, but I think we may be oversimplifying it in many ways. When you think about who is going to benefit and how much will they receive, typically you're talking about individuals like your surviving spouse, children, grandchildren, other family members, could be a friend. You want to consider that individual or the multiple individuals. You want to consider what is their financial stability. What is their life stage? We talked about, where they are in their earnings cycle. What are some potential vulnerabilities? Unfortunately, we do need to consider things like substance abuse and debt. If they're in a profession that is, has a potential for high lawsuits, think attorneys, and who are they going to go after? Yeah. Doctors. They're going to go after business owners. Yeah. Folks that have the potential to be sued. And so when they go after assets, it could include the inheritance that they receive from you. And the other important consideration when you're considering, who and how much to give, more specifically the who, think about this. And I often say that money amplifies existing traits. It's almost like turning the volume up on things that are already there. So if somebody is already generous, if somebody is already making wise financial decisions, typically when you turn up the amount of money they have, that will amplify those traits. And on the contrary, if you're seeing problematic situations, poor money decisions, bad habits, and you turn up the amount of money that they have, that tends to intensify those as well. So those are very practical and real life considerations. Now, what about charities? Think about charities that align with your values. When you look out into the world and you see things that are broken, what breaks your heart the most? It could be a variety of things, poverty, and it's very important to make sure the charity is credible, they're financially transparent, and the impact they're having. And I'll mention, typically you are naming a charity, but you have the ability here to really do something interesting. If you, instead of naming specific charities in your Charitable Remainder Trust, name your donor advised fund, you may already be using a donor advised fund. You may already include your children or your grandchildren or other family members in the decisions around what charities to benefit. You can actually continue that and fund that at the end of their, the beneficiary's life, really just continuing a family legacy of giving. And that's a tremendous opportunity. You can use private foundations and donor advised funds as beneficiaries to a charitable remainder trust. And when considering how much, I do want to mention that most people, let's say I had 2 children, I'll give them 50% each. I'd like you to consider an alternative. we love our children equally. And if we love them equally, we need to treat them uniquely. If one child goes into the arts and is, the typical starving artist, and the other is a surgeon, are their needs equal? And would we be really treating them fairly if we left the same amount to both? So that's just a consideration. When we talk about spending guardrails, I really like to ask the question first and foremost. Let's say we have $1 million left over in an IRA after the surviving spouse passes away. Would that lump sum, would access to $1 million on day one be more of a blessing or a curse to that future generation? We all know, and we've heard the stories about how lottery winnings and professional athletes who make a lot of money in a short time period, what ends up happening to that money? Oftentimes it gets squandered. And then are they any better off for it at the end? So there are ways to structure your giving, and a charitable remainder trust is one perfect example to provide an income stream. So instead of $1 million day one, you might be getting $100,000 in year one, $105,000 in year two. And it could be a growing income stream over the course of their life. And some of the benefits there, you're encouraging healthy money habits. Somebody who may not be used to managing wealth now has the opportunity to almost like working out. You build up those muscles. You don't ask them to lift the 200-pound weight right away. Yeah. You're preventing the rapid depletion and really teaching wise money management techniques. And lastly, I want to talk about minimizing taxes. We've already talked about that so many times, but using that example of $1 million, and let's say there was no growth, and let's say that was distributed over 10 years, that's another $100,000 of taxable income that goes to your future heirs, and that adds on top of their taxable income. That could bump them up. There are ways to structure this where you use the guardrails, provide a smaller amount of money on an annual basis, and then they still provides for all of their needs, but you're significantly minimizing taxes. Another consideration too is your estate may be able to receive a charitable deduction for the contribution to a charitable remainder trust. Ultimately what I want to say with this, and we could go much deeper, is transferring wealth wisely really requires careful consideration. It requires some time and energy, some thoughtfulness, addressing both the benefits, but then also the potential downsides of passing on wealth. And implementing spending guardrails is oftentimes a very wise way to structure passing on wealth. At the same time, you could be minimizing the taxes and ultimately leaving more money to your loved ones and the charities you care most about.
Yeah, it can truly create a win-win-win. And one of the things I want to call out is two of the scenarios where you see people squander wealth the most is, one is without spending guardrails. Again, you put a kid in a candy store and if they don't have self-control, they're going to eat it all, right? And the idea of you just give them this money all at once, those are some of the most common scenarios where people lose kind of inheritances or wealth, which is why one of the most common ways for, whether it's with a charitable remainder trust or other trusts, there's typically limitations on how much future generations can pull out per year, because the idea is you don't want one bad decision or one poor beneficiary to impact all the kind of future generations or their long life, just because they make, maybe they have a bad period in their life. You don't want that to impact kind of their future and squander that. And one other piece that's to call out here is kind of mention two benefits. In a lot of cases, for typical transferring wealth wisely, a lot of times you actually don't want to transfer it directly to an individual, because George mentioned this. Maybe they're in a litigious profession, or maybe they just get in a car accident and they get sued. A lot of times, kind of when you transfer wealth, when it's meaningful amounts, a lot of times will transfer it to a trust for that individual. So in the situation that person gets sued, whether it's their job, it's a car accident, who knows what,
okay,
those assets are protected. So again, it's preserving the randomness or life or their job or whatever existential risk, plus potentially the individuals, if they don't have that muscle to control how they spend it, is putting it in these ways that are, taking a little bit step back and more protective in multiple aspects.
Yeah. Some examples that we often see is, let's say you're passing on money to a child who has special needs. That could compromise some of the benefits that they're eligible to receive.
Yeah.
So this is another way to be intentional about how you transfer money to them. Or in the unfortunate case of a spouse, your kids are married at the time, everybody's happy, and then down the road they decide to divorce. If not managed appropriately, half of that money could go to the divorcing spouse.
Yeah.
Just some additional examples.
Yeah. Now, we mentioned this a lot of charitable remainder trusts, but also known as CRUTs for short, adding it as a beneficiary to your kind of IRA. I just want to give a little bit of context, though. So why does this make sense is, we mentioned this before, it allows you to defer tax liabilities even further, which allows you to create more wealth. Essentially, again, keep on hitting on this of compounding is, if you can avoid paying ordinary income taxes today, reinvest that money, you're going to come out ahead in the future. And that's really the premise of a charitable remainder trust, is instead of forcing you to withdraw all that money within 10 years, it allows you to withdraw that money over your lifetime in a tax advantage way. And so that's really kind of on a tax benefit, is you can defer the taxes. You can, on the growth, when you reinvest that money inside of a charitable remainder trust, instead of paying ordinary income taxes on that growth, you can pay capital gains taxes, which will be lower. And then it also gives you more flexible timing of, to George's point, in your peak earning years, you may or may not need it, but it gives you the optionality that you don't have to take it out within 10 years. You can withdraw it over a longer timeline. Maybe wait till, if you need it when your kids are in college or retirement, you have that flexibility versus being stuck to that 10-year period. And the final piece is to kind of what we hit on is, charitable remainder trust has some asset protection pieces where that if you're sued, that those assets are protected so that you may not lose everything, or in the event of a divorce, there's some additional benefits there that not only enable you to reduce taxes, but reduce the potential liabilities from these external events. Right. That's the real reason people post the Secure Act use charitable remainder trust as a beneficiary to IRAs. Any kind of other big benefits, and we'll jump into, I know people probably have questions on how does this work. We'll jump into that next. Any kind of other big benefits you think we're missing here, George? There's kind of spending guardrails, those pieces, but any other high-level benefits?
I would just like to summarize that trusts have been used for centuries, and sometimes you're protecting the beneficiary from themselves. Oftentimes you're protecting the beneficiary from outside dangers, and so this really applies, and it's an awesome vehicle outside of the tax benefits to being able to provide that type of protection.
Yeah, it's a really good call out. Is the origins of the trust in the U.S. legal system came from England, and the original idea was to protect landholders from lords and kings and protect basic land rights. The idea was to actually protect individuals from government, whether it's tax or asset protection, and those are some of those kind of reasons. So we'll jump into kind of how does this work, and I'll start with maybe kind of what's the benefit of a charitable remainder trust. It's a tax deferral vehicle, so it's very similar to actually an IRA. And the idea that when you put assets into a charitable remainder trust, you don't pay taxes on the gains or income realized inside of the IRA. But when you pull money out of the charitable remainder trust, that's when you pay the taxes. And it typically keeps tax nature of that income. So it could be ordinary income or capital gains if you're investing it in, let's just say, public stocks or getting dividends. Now, with an IRA, you roll your IRA into the charitable remainder trust when you pass away or when the last spouse passes away. So it's what's called a testamentary CRT. It goes into effect when you pass away. Now, typically this charitable remainder trust is set up for the life of, assuming it's your kids that are the beneficiaries or grandkids, it's set up for their life. So let's say you have one son and he inherits it when he's 50. Your IRA proceeds will roll over into his charitable remainder trust, of which he's a beneficiary, and that charitable remainder trust will last for the length of his lifetime. Now, over the course of his lifetime, the beneficiary is entitled to take distributions every year that are a specific percentage of the trust assets. It's typically somewhere between 5 to 10%. So what that means is, let's say there's $1 million in the charitable remainder trust, and let's say that percentage is 10%. That year, the beneficiary, so your son, is entitled to $100,000 of distributions. Let's say the term remainder trust value is worth $2 million. Then in that year, they'd be entitled to 10% of that, or $200,000. Every year, you're entitled to a distribution from the beneficiary is entitled to a distribution from the term remainder trust. Now, when they do get that distribution, they pay taxes on it. So it's not tax-free. Again, it's tax deferred. But the idea is they don't have to withdraw it within 10 years. They don't have to pay the taxes up front. They can take these distributions over the course of their lifetime and pay the taxes later. And there's versions of charitable remainder trust. We're not going to go too far into this, but there's versions where you can actually defer those distributions. So you don't have to take that 10% every year. You could take a smaller percent, or essentially 0% for the first 10 years, and then have accrue that amount that you didn't take and take larger distributions 10 years later when you retire, when you want to buy a vacation home, when you want to pay for your kids' college. You can really kind of customize it to, again, one of the things we call is the flexibility of when you need the money, when you maybe have a lower income, when you move to a low tax state. There's a lot of reasons that enables you to, A, take advantage of compounding, grow it tax-free, withdraw it over a longer timeline, and do it when it fits your life situation. Any other things, George, you think I'm missing of kind of how this works with the IRA rollover or other important pieces to it?
I would just add, as sort of an overarching principle, these are considered split interest gifts.
Yeah.
And so the immediate beneficiary is typically an individual or multiple individuals. The remainder beneficiary is a charity or charities, or it could be a donor advised fund or a private foundation. There's different charities that qualify. And we'll talk about what is the role of a trustee and how are these structured. But the goal is really to benefit both classes of beneficiaries. And so there's ways to structure it so that, you sort of get your cake and eat it too. And these have been tremendous vehicles that I've seen work very well, helping both the individuals and the charities. Manny, your company has such awesome education on your website and through other webinars you do. Highly encourage you to learn more about charitable remainder trusts. A charitable remainder unit trust is one type of charitable remainder trust, the one that we're going to focus on today, but there's other options as well.
Yeah, it's a really good point. I didn't miss the charitable piece, but there is typically the assumption is the beneficiary, whether it's your kids or whoever you name to receive that, they're entitled to distributions every year. And when the trust ends, let's say you set it up for your son's lifetime, when your son passes away, the trust ends, and whatever's left in the trust, that remainder, that's what goes to the charity of your choice. So as George mentioned, that could be the donor advised fund. It could be the Boys and Girls Club, could be the Red Cross, could be your church. It could be all of the above. It could be, and this is where it's like you hit on this point of it's really, there's kind of a couple interested parties. George already mentioned the reason that the Secure Act was created was the IRS wants your money. They want more tax revenues. Really, when you look at your IRA, there's kind of you and your family as interested parties. There's the government because they want their tax revenue. And with the charitable remainder trust, what you're doing is you're actually decreasing the size that the government gets. You're giving some amount to charity, but really what's happening is you and the charity are winning at the expense of the government.
Right.
And that's kind of that's the trade-off. That's why it's a win-win. I'd say it's a win for you or your family, a win for charity, and it's a lose for the government, but they're okay because the charity's coming ahead. And that's a really important piece to understand.
And I'll caveat that with saying something that I like to say is give unto Caesar what is Caesar's, but don't give Caesar a tip. And by structuring it this way, the government understands and knows and approves of these charitable remainder trusts. This isn't something that, some clever attorney came up with and the government doesn't know about. These are fully vetted, approved. There's even language on the IRS website, of how to structure these. And so this is fully legal. They understand, yes, they might be getting a little bit less tax revenue, but the benefit to society of being able to support charities that are doing very important work, the government can't help everybody. Yeah. So these charities are really involved. And so that's why they're willing to give up some of that revenue, is ultimately to better society. And so it really is a win-win all around.
Yeah. It's a really good, important piece to hit on. These charitable trusts have been around since the origins of the U.S. legal system. The last time that the IRS really functionally changed these were the 60s. And that was just kind of actuarial methodology, but the structural thing hasn't really changed. There's a couple of questions here. So I want to ask this question of, can CRUTs have commingled assets? There's a couple ways. I don't know if you want to add more context. There's a couple ways to interpret this. You can have different types of assets. You could have public stock, private stock, real estate. You could have different types of assets. Typically, you can transfer with an IRA. You'll typically just transfer that once. You typically wouldn't transfer it from non-spousal grantors to the same CRUT. I'm not sure if you could, but I'm not sure. Oh, and let us know if you're talking about a different scenario there. There's also a question here as to, do IRAs not allow taking distributions for the first years? So after you inherit it, you're actually, George, feel free to jump in. You're actually forced to, if you don't pass on to Charitable Remainder Trust, you're forced to withdraw it all within 10 years. And there's actually, because of RMDs, there's actually typically minimum distribution requirements for each of those years.
Correct. The IRS actually recently clarified the Secure Act 10-year rule, and typically if the person that passed away was already taking their required minimum distributions, at a minimum you need to continue taking required minimum distributions, and then by the end of year 10 everything leaves. If they were not already taking their required minimum distribution, then you could potentially defer taking it for 10 years, but then you're just taking an even bigger tax hit all in 1 year, year 10, which typically does not make sense unless there's unique circumstances.
The one thing I'd say is, this is where it's like passing on the IRA directly so that someone else to withdraw it. The two scenarios where this makes sense are, you need the money right away, or you would withdraw it within 10 years. If you're going to do this anyways, if you were going to withdraw it within 10 years, or you needed the money up front, then not using a Charitable Remainder Trust makes sense. Or if you never plan to, when you inherit it, never plan to spend it during your lifetime, then it may not make sense. But if you're kind of in the vast majority of scenarios where you're passing on with the intention, or inheriting it with the intention to spend some of it, and it's not all in those first 10 years, this is really where the Charitable Remainder Trust as the beneficiary makes a lot of sense. It's kind of another question of, can a beneficiary establish a CRUT and move their inherited IRA assets into it, or does it have to be set up by the original owner? So it does. The IRA owner has to set up the Charitable Remainder Trust as a beneficiary before they pass away.
Correct.
And George, you want to talk about how you typically work with your clients to kind of set this up so that it avoids custodian issues, legal issues, and just making sure that there's that clarity there?
Yes. That's an excellent question, because if I were inheriting an IRA and let's say I was inheriting it from my parents and they hadn't done this work, unfortunately, it's too late to take advantage of this strategy. You could potentially take distributions and put it into a CRUT, but that's not what we're talking about here. Really, it's working with that previous generation for the benefit of the future generation, and setting this up ahead of time.
Yeah.
Maybe an extension to that question, you also can't put your IRA into the Charitable Remainder Trusts, if it's your IRA, while you're still alive.
Yeah.
Unless you liquidate your IRA, pay all the taxes, then that wouldn't make sense either. So really, the scenario we're talking about is somebody passes away. Typically, they'll leave it to the surviving spouse, if there is one, and then it would be left to typically family, children, grandchildren, and then just there's all sorts of distribution options in terms of how they take that out over the course of their lifetime or over a certain number of years. There's so many ways to structure it.
Yep. Yeah. Now, a couple more just questions, and we'll move on to the next slide. You are actually entitled to take distributions every single year from the CRUT. Now, there's typically a maximum that you can take per year, but you're entitled to a distribution every single year from the CRUT. And again, that distribution you're entitled to every year, it's a specific percentage of the trust assets. And that percentage is consistent every single year of the trust. It's set up when you create the trust, so it's something you'll know up front. It won't be a surprise. And that annual distribution is, if that percentage is 10%, 10% of typically the end of year value. So if the trust is worth $1 million at the end of the year, it's $100,000. If the trust is worth $2 million, typically about $200,000. There are some unique things. There's a structure called a NIM-CRUT where if you don't take the distributions you're entitled in earlier years, you can essentially accrue for those underpayments and take a larger distribution to account for that in later years. Last question before we move on. There's how many generations can a CRUT pay out before having to go to charity? This is a really good question. Is it only the children and grandchildren alive when the CRUT goes into effect? So the beneficiaries of the CRUT have to be alive when you set up the Charitable Remainder Trust. There's also the trust has to have an expected life on the maximum end of, I believe it's 57 or 58 years. Slightly depends on what the current interest rate is. So if, for instance, you could set up a Charitable Remainder Trust for your kid's lifetime if they're 27 years or older today. If they're younger than that, there's variations you have to do. If you're including multiple generations, there's ways you can structure it. But so the short answer is they have to be alive, and they have to be, you can only set up so that its expected length is a certain age because of IRS rules.
Right. It goes, here's the principle here. The IRS has certain calculations that, Manny or myself can help you out with. And ultimately they are trying to say, is this really going to benefit charity at some point? Or is the vast majority of the benefit going to accrue to the beneficiaries, and essentially a pittance or nothing is left to charity at the end? So there's a balancing act, and there's some calculations that we do to figure out how to best structure it to benefit the people you want to benefit in the amount you want to benefit them. One of the prior questions was, can we, essentially delay taking it as long as possible? There are limits to how long you can delay passing it on to charity. And on the contrary, if somebody wanted to, let's say, I want to pass on my IRA to my son, and I want him to be able to receive, X amount for 20 years, and then I want it to go to charity. You could do that too. You don't have to have it last for the entire lifetime. And then if the son is still alive and it goes to a donor advised fund, the son could also be helping to, continue that charitable legacy that the family has established. So there's so many ways to structure this. They are, unique, and every person's situation should be considered uniquely.
Yeah. Let's we talked. I know there's probably, we can also save some of these questions on how CRUTs work for the end. We can also set up time one-on-one. Maybe George, let's dive into, there's a lot of benefits to using Charitable Remainder Trust as to, hey, you get this tax deferral, more flexibility, you can defer taxes for longer. But maybe let's talk about kind of like, what's the importance of structuring these correctly and the roles and responsibilities in managing these Charitable Remainder Trusts.
Sure. I'll sort of give you the summary first. Is in a charitable remainder trust, just like with any trust, there's a trustee, or there are trustees, and especially in a charitable remainder trust, they play a very vital role in the proper administration and the investment management. Things like due diligence. They need a certain level of expertise to be able to do this. So the way I like to set the expectations is, this is typically not a DIY. You're probably not going to be able to do this with a brokerage account and a spreadsheet. You do want to involve some experts in various aspects, which we'll talk about in just a minute. But I'd like to talk about, protecting and growing the assets, acting in the best interest of the beneficiaries, keeping accurate records, and annual tax filings as well. There will be a trust document that establishes the parameters, and there's specific language that needs to be in there to qualify as a charitable remainder trust. It'll identify beneficiaries, whether they're individuals or whether they're charities, and it needs to adhere to the terms of the trust. So that's very important, that somebody is comfortable managing per the document. That's sort of the language that I always grew up hearing, is per the document. And one of the things is very important, if you're a trustee of a charitable remainder trust, You can wear multiple hats as a trustee. You could wear the administrative hat. You could wear the investment management hat. You could wear both, or you could delegate those. And if you're a trustee of a charitable remainder trust and you don't have that skill and experience and expertise, you're actually required to delegate, because that's the prudent thing to do to others that are knowledgeable. So seeking out knowledgeable expertise is critical if you don't have that expertise yourself. Keeping detailed and accurate records, tracking all of the income. And Manny alluded to this, there's different categories of income when it comes to the trust. So typically when we're talking about an IRA, a pre-tax rollover or traditional IRA, initially all the money that goes into the trust, it sort of comes out of the IRA, goes into the CRUT. That's all taxed as ordinary income were it to be taken out. Now, as that trust continues to grow, now you're accumulating other categories of income.
Yeah.
It could be capital gains, short-term, long-term. It could be tax-exempt interest. And so we're not going to get into the details, but it's important to make sure that you're keeping accurate records of the different categories of income. When we talk about tax filing, the trust itself has specific tax filing requirements annually. Then they have to provide a K-1 to the beneficiaries, which then they will use to prepare their taxes. And so that's a very important, making sure that it's timely, it's accurate. We're income distribution. So per the trust, per the document, making sure that those distributions are happening in the way that they're supposed to. Not missing a year, that could be very problematic, and making sure that the calculations are accurate and timely, accounting for changes in trust value. And I would say the other thing to consider is the trustee has to maintain communication with both classes of beneficiaries. The remainder beneficiary is just as much a beneficiary as maybe your child or your grandchild is. And so they are entitled to information just like your child or grandchild is. And, it's interesting, having worked with many charitable beneficiaries, some are more proactive on checking up and making sure that the assets are invested appropriately than others. And so that's another role and responsibility of a trustee, is making sure that they're accountable to both classes of beneficiaries. They're treating the beneficiaries impartially. You can't favor one class versus another, because it really is a split interest trust.
Yeah.
When we talk about the investment aspects, there's without getting into too much detail, there is something called the Uniform Prudent Investor Act and other similar state laws that do come into play when you're talking about trusts, and making sure that you have a duty to diversify. And that's important, because if you are holding 100% of the trust proceeds in a stock, and then that stock decreases significantly, and you can't recover from that, the trustee is the one that's on the hook for that type of decision, because that would be considered imprudent. So diversification, making sure that you're balancing income and growth. You can't overly favor the current class of beneficiaries, maximizing their income to the detriment of the remainder. And there's plenty of case law study showing how the remainder beneficiaries, the charities, have actually brought suit against the trustees because they did not act in balancing, the income and the growth. They were not impartial.
Yeah. One thing I'd say, so we at Valur, we manage the kind of administrative side of a variety of trusts, whether it's insurance trusts, non-grantor trusts, intentionally defective trusts, CRUTs, crummy trusts, CRUTs, an alphabet soup of these things. And term remainder trusts are the most complex because it's a combination of they're tax exempt. There's this split interest between the charity and the individual. So there's a different, there's a balancing act of representing their interests, the tax exempt nature, the reporting. They have their own unique accounting system. It is just, and then kind of managing kind of all those benefits with the item investments. We've seen people try to administer this themselves. We've seen no one successfully been able to do that because of just the complexity and all these different kind of pieces that go into it. Yes, and as part of that, first of all, like I call it, if you have a tax exempt entity that you can also benefit from, there's a variety of reporting, whether it's on the investment tax side. The government doesn't let you just do this stuff without any insight, and so depending on the state and always at the federal level, there's a level of reporting that you have to do that just takes place here. Kind of just in the interest of time, any other pieces you want to call out here, George?
No, I think we covered it pretty well.
All right, so let's jump into, people love to see, it's what is the financial impact of this? It's, you built up this wealth during your lifetime, put a lot of hard work. Like, what does this financially mean for you and the next generation and your grandkids when you pass this on? So let's take this. Rocky and Nellie, they live in California. They've accumulated about $2 million in IRA. The plan is to pass on to their son, their only son, Adam. We're going to kind of assume that he's going to pass it on in 15 years when their son, Adam, is 56. And really the goal is they want to maximize what Adam gets out of his inheritance. And there's going to be a lot of things. At one level, it's the holistic dollars that he gets. But then also, to kind of George's point, they want to add some guardrails so that it can't blow it all at once. There's the ability for it to kind of live on. So they pass it on. They kind of look at it between a terminator trust and not passing it on. And kind of the idea here is, and George, you can feel jump into the numbers. Really, the comparing of if they use a terminator trust to pass it on, and when Adam inherits it versus without. And really, the idea is that he's going to be spending a certain amount of it every single year. And really, it's comparing how much should they get in each scenarios. And George, you want to jump into kind of into the numbers on kind of what are some of the trade-offs here?
Yeah, and very simply, it goes back to that graph of tax deferred growth versus taxable. So, the more money that gets taken out upfront from taxes, the less that gets to accumulate on a tax deferred basis. And so, we are assuming a relatively high tax rate. So, out of that 2 million, about half of it goes to tax, which is not unreasonable with many of the folks that we work with. And then you basically have
California. So if you live in California or New York City, right, like a 50%, and again, if this is a lump sum or because of RMDs, you're forced to do this in a tight time period, a 50% tax rate plus you have other income is not a kind of unreasonable expectation. Now, it'll be lower if you're in Texas, but this isn't uncommon as to what we see here.
Correct. And this doesn't even consider estate taxes if you're subject to estate tax. So, what are you left with after all is said and done? We're assuming this goes out over 35 years, about 2.2 million ends up accruing to Adam. Now with a charitable remainder trust, and I'll say 0 goes to charity in that first scenario. With a charitable remainder trust, if they were to leave their $2 million IRA and upfront, there's no taxes paid. It pours into this tax deferred charitable remainder vehicle, and the amount gets to grow. So in this case, we're assuming an 8% growth rate. And then there is an assumption here. This is a little bit of a nuance of a typical charitable remainder unit trust, where this accumulates. It's called a net income charitable remainder trust, a NIMCRUT. It gets to accumulate, and the net income is paid out for a series of years, and then the regular periodic distributions begin. That's another way to sort of stretch it even further. Instead of year 1, Adam starts to receive 5%. And so at the end of the day, after 35 years, the net accumulated amount that Adam gets to receive is more like $3.4 million versus $2.2 million over the course of his life. Most of that is just, again, there's nothing magic here. It's tax deferred growth. And each year, by the way, even if you set it up for a percent each year, that percent is typically growing if the account is managed well. You're sort of giving 5% of a bigger and bigger pie each year. So we talked about here, it gives about 56% more wealth is preserved. And, the really sort of the cherry on top is $2 million gets to go to charity tax-free.
And that's on top of the 3.4, right? That's not as part of the 3.4. That is truly the cherry on top. The 3.4 versus 2.2 is the ice cream sundae. The cherry on top is the additional to your donor advised fund or the causes they care about. Correct.
So, I mean, the Secure Act has made this a very important consideration, especially if you have a sizable IRA, rollover IRA, and somebody will be receiving an inherited IRA. There's no magic number, but if you've got 10 kids and it's $100,000, it probably doesn't make sense to go through the effort of setting up a charitable remainder trust because, if you're giving it equally. But if you're talking about this type of a scenario, or we can, talk about other unique scenarios, it becomes a very compelling use case and can be a tremendous win-win.
Yeah, that's 100% true. I think it's, you typically, we see it starts to make sense at kind of north of $500,000. The higher the tax the state you are in also kind of helps that of, again, deferring taxes becomes valuable the higher your taxes are. So that's the other piece to call out. We're going to get into, just before we get into, I know there's some open questions here, just because we're going to probably run up against time. So I'll say one is appreciate everyone for joining us. If you want to learn more, you can reach out to us directly at monty@valur.com or george@cornerstonefm.com. You can reach out if you want to set time to go deeper, go into your personal situation. We also both have kind of learning materials on our site that you can see there. And so, we'd love to hear from you, schedule more time to kind of help you go more in depth. We'll send up a follow-up with recording this webinar and some resources so you can calculate these things by yourself, read more about it, and also connect with us with our contact materials. Now, there's a couple of questions here that I'm going to get into. So Owen mentioned if the distributions of CRUTs are taxed depending on the types of assets, would the tax situation for the beneficiary receiving distributions be prorated based on the types of commingled assets? The answer is yes. And so this is part of kind of what we do. So we don't do the investment side. So as an example, so George manages the investment side. We'll do the accounting, the administration, and tax filings. Part of the work that we do is tracking the different types of income, whether it's ordinary income because it's an inherited IRA, or if it's capital gains because you reinvested in it to growing after it's contributed to the charitable remainder trust, or if you have qualified dividends versus unqualified dividends versus tax exempt. We have to track that. And then charitable remainder trusts have very specific rules. It's called 4-tier accounting as to when you get the distributions, there's an order as to when they get that. And then, yes, as a result, from your point of view, you're just getting effectively a K1 or 1099 that gives you, here's your distribution. And then here's your kind of how it fits from a tax thing that fits on your tax form. Very similar to a K1 from that point of view. So the net answer is your tax liability on that will change based on the investments and the type of income in the trust, but it really shouldn't be additional work for you. This is a really good question from Chris here. What happens to the tax benefit from the charitable gift? I briefly mentioned this. When you set up a charitable remainder trust, the rough estimation from the IRS is that it's what's called the income beneficiaries. So typically your kids or grandkids in this scenario are going to get about 90% they have a 90% interest in the trust, and the charity has a 10% interest. In reality, because the government has very conservative growth rates, your beneficiaries tend to get a higher percentage and charity tends to be a little bit lower. But you get a 10% charitable deduction. So again, if you contribute $1 million, that's a $100,000 charitable deduction. In the case of when this happens, it would apply to reducing the size of your estate tax if you are facing one. So that's when it would impact, if you're over the lifetime exemption or trying to pass that on, that's when it would reduce the size of your estate tax or potentially reduce it down to zero. Anything I'm missing there, George?
No, I do think because these are very prescriptive per the IRS, you can run multiple scenarios and see, okay, if I give this much and it lasts this long, how much so that's relatively easy to figure out beforehand. If you're looking to hit a specific charitable deduction amount as part of your estate, we can work with that.
Yeah. And so again, and that's, I think just, we'll probably end it with that is if you want to kind of run through those scenarios, please feel free to reach out directly. We can happy to run through those scenarios, talk more in depth about kind of your situation, or just answer any questions you have about these structures. And we'll be sending a follow-up email today so that you'll have this recording as well as some of these resources and our contact information. And so, George, I want to thank you for joining and everyone else for joining this webinar. Hope it was helpful, and looking forward to doing this again.
Thank you so much.
Take care.